Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com. or text or call Andrew at 469-207-5844. That's 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
All right, welcome back. How is everybody doing? Hope you are doing well. Andrew Kuhn, Focused Compounding Podcast. Happy Thursday. Geoff Gannon, happy Thursday.
Happy Thursday, Andrew.
Happy Thursday, even though what's today? It's Tuesday.
We don't record on Thursday.
We're recording this on Tuesday. We're recording this on Tuesday, 6:30 p.m. Tuesday in Dallas.
Yeah, so if something happens on Wednesday.
Yeah, there you go. Hope everyone has had a great week. Hope you are going to have a great weekend. We are going to be going over some more questions. People have tweeted us and emailed in, so if you do want to do that in the future, feel free to either DM me at Focused Compound or send me a tweet, or you can email info@focusedcompounding.com, and Jeff's is Gannon on investing.com. If you do like the work we are doing here, feel free to rate and review and on iTunes. And if you want to get a 1,000-word write-up from Geoff every week, go to Focus Compounding for free, and you can enter in your email, and I'll put you on that email list.
Yeah, sometimes you also get them from other people as well as me, and it's not always just one.
That is
correct. So the first 1,000 words of everything we put up.
You got it. Alrighty, first question. Any views on the latest Berkshire meeting?
Mm-hmm.
And then he also asks, and since you print out 10k's to read them, what do you do with them afterwards? Do you keep an archive for the ability to revisit them? And then he asked again, what books do you revisit most often? So we'll go down the list. What's your thoughts on the Berkshire meeting?
Okay. Berkshire meeting, fine. It's like it always is, right? You saw the Berkshire meeting too. We both saw it on Yahoo Finance.
Yep.
Yeah. Yep. So, the question and answer is mostly like all the others that we see. Occasionally there's one, question or something that's really interesting.
Yeah. People were disappointed, I think, that we didn't go. I got a lot of emails about it. And
it seems to be a big networking, socializing thing for a lot of value investing.
Yeah. Somebody was telling me that you should at least go to the meeting once.
Yeah.
But that the best part about going is the socializing, just kind of being around a bunch of other people and meeting up with individuals and stuff. So maybe next year we'll go.
Yeah, neither of us have ever been to the Berkshire meeting. You have been to the Daily Journal meeting, correct?
Yeah, and that was tons of fun. So, I'm sure it's just a huge convention. It just looks like so much fun. So we definitely got to go to that next year.
Okay.
But
what'd you think of it?
I enjoyed it. Same thing. I think there's a genius and I was telling Geoff on the way to our office to record that I've been watching the archives. So you go to buffett.cnbc.com and you could go back, and I started at 1994. And I actually heard Monish, he talked about doing this. I'm like, that's a great idea. So the first thing he does in the morning, he says when he's taking a shower, I don't do that, but he listens to the archives.
Okay.
And he's like, so I get to spend 30 to 40 minutes, to hang out with Warren and Charlie every single day. So I thought that was a good idea, on my commute and stuff. Idea, So I'm back in 1994. I started this the other day. And I think there's a genius in how they still say a lot of the same stuff in present times that they were, 10 plus years ago, a very long time ago, which is great because, the principles haven't changed. And it just, if in my opinion, it should show that, it's sort of withheld the test of time. You got to always learn and continue to get better as an investor and everything, but there's still, their general philosophy has never changed, in my opinion, other than maybe from partnership days to Berkshire because of capital constraints or whatever, but it's all pretty much the same. But, views on it? No, it's just always fun watching them. It's incredible. Their age, Munger's 94 and Warren is 88, and both of them are incredibly sharp still. And just really, it's a lot of fun for me.
Yeah, I'll sing out two questions that were there that were pretty good. One was what was their most interesting personal investment, I think was one of them.
Yep.
And that was an interesting one to watch.
Never heard Buffett talk about that before.
Yeah. Heard about the Duck Club or whatever.
Yeah.
Actually, there's a stock nowadays has very strong similarity to that.
Yeah, what did he say happened? Something about shooting a gun?
Yeah, they found oil.
Yeah.
So it's basically, so it was a club in which they found oil. Yeah, so it wasn't intended to be started up as a big for-profit thing, and then they found oil. And I actually know a company that's very similar to that. I won't say it's a very tiny company, but that exists today over the counter and has some similarity too in that they found, it's the same thing, mineral rights after being created for a different reason. So, and then we have the other one that I thought was really interesting actually wasn't answered by Buffett and Munger, but it was a question about Progressive and Geico. And they did a really great job in terms of having an answer about insurance about the respective positions of Progressive and Geico. We have a write-up on the website. It's like a 10,000 word report, I guess, that I did on Progressive, which I picked as a stock years back. And they really nicely summed up why Progressive is getting into the combining renters and auto. But more than that was what the question was about. But more than that, it was describing, which I thought they did really well, that Geico has a cost advantage versus Progressive, but that Progressive is a better underwriter, basically. And that's true. So, by the way, they're both great stocks. You can't buy Geico other than through Berkshire, but you might want to consider Progressive yourself. I would imagine that for sure Buffett would own Progressive stock if it wasn't for the fact he owns Geico already.
Did you see when Ajit Jain, when he answered a question for Buffett? Did you see that? A lot of people were talking about, they're like, is because his hands were shaking so bad, so people on Twitter were like, is this a health issue? Or is he? I was like, he's probably just nervous.
Probably nervous that they suddenly said, okay, stand up and answer a question.
Imagine just like, just like hanging out there. He's probably like on edge the whole time too, like wondering if Lawrence can like defer to him or whatever to answer something. And then like all of a sudden, get this guy a microphone. You're gonna speak. Yeah.
No, I saw what you're talking about. Yeah. I assume that
nerves for sure.
Nervous at being called out.
Yeah.
Can you stand up and get a spotlight on him?
So random. Yeah, totally. Everyone, the whole place is looking at you. Yeah, 100%. Okay, so since we print out 10k's, what do you typically do with them?
Yeah, I do generally. I keep them. So I put a clamp on them, put them in a folder and stuff, and things like that. Some cases I know that I'm not going to use it again and stuff, and then I don't need to keep it. But in other cases where I am planning to, I keep it.
Do you recycle?
Do I recycle the paper? No. And we get a lot of complaints about from people about our use of paper. And then the other thing is I usually have a list of like 5 companies that we don't own that we might own, and so definitely all of those things I keep stuff on.
Yeah.
In terms of like stuff that I looked at a long time ago, wasn't interested in at all, thought it was too risky and stuff, no, I don't necessarily keep that. I used to, when I had a different living arrangement where I could fit more of it, have like 6 or 7 file cabinets full of stuff. That's not really an option where I live now, but so I do keep it, especially if it's potentially going to be interesting again. I write directly on the 10k's and stuff. I don't really keep a lot of separate notes. What do you do?
The exact opposite. I keep separate notes. I usually have like a legal pad next to it, and then what I'll do is when I find something interesting, I'll just write on the legal pad page 3 and then like a little note or something like that. Like I'm underlying on the 10k and stuff too that I find interesting, but I use a legal pad as well. And then I do put it in Excel
right
afterwards, just like just for note taking. Maybe my memory's not as good as yours, but that's what I do, and just kind of helps, I guess, keep it all in one place. And then when I'm done with the 10K, typically I do throw it away.
Yeah.
And then, from there, if I'm going to look at the company in the future, maybe go to the most recent 10K or something. But I have all the notes and I guess all the work that I did. It's all in one Excel file.
Yeah, and I keep digital things too. I should say I do create a folder and put in all the annual reports I can have from the past and all the presentations and stuff. So I also request sometimes from companies, I think I mentioned that before, no matter what, even if a company, we do some that aren't SEC filing companies, but like if a company only has 8 annual reports on their website, I'll always write to investor relations and request every annual report they have that is not included there that they might have and stuff. Sometimes they send it, sometimes they don't, but I've gotten them to send me 10 years that aren't up there and stuff before. So
cool. What books do you revisit most often? Like any good literature, they say the best literature you could reread right after you finish it.
The Snowball would rank pretty high.
Do you do that because there's information you're getting out, or is it just like inspiration? You just enjoy the story?
That's parts of the Snowball, I would say, is actually information to revisit. Yeah. Yeah, you can be a stock market genius. Yeah, for me, it's the ones with case studies, basically. Yeah, some sort of actual thing that they invest in. I actually read Phil Fisher a lot, probably. I would say too. Don't talk about him that much. Peter Lynch too. So anyone who just talks about a lot of different stocks at the time, and I'm always really interested in reading things about stocks that were from a long time ago compared to today, when the market's a lot different and stuff like that. I think that can be really helpful, not to get too focused on what it's been in the last 10 years or something. It's very easy for people to start to think that the prices that you see now, the earnings growth you see now, the interest rates you see now, whatever, is the only one that there is. And it's nice to read from different periods in which things were so different, and to kind of be able to think seriously about the possibilities of, how different sometimes things are from what they are now, to have a longer term view.
Yeah. I would say for me, I do have like a couple of books that I like to reread every single year, only because, like I said, I mean, there's some of them every time I do reread them, I'm like, wow, I did not pick this up the first time I read it. The Snowball is definitely on there.
Okay.
And that's kind of leads me to another point, something I do a lot. So it's like Alice Schroeder, right? So she had direct access to Buffett, right? So obviously you're not going to get all this you and I aren't going to get so much information from from Warren, but you could almost like go up the food chain and get close with people that are close to them to learn a lot about how that person is. So it's like The Snowball, right? That's an incredible book. Alice Schroeder, I've also talked about. She did a Reddit like ask me anything type thing, all on Warren Buffett. It's like, that's like, I always talk about, like, move up the food chain. You may not be able to get in contact with Warren, but if you want to learn about him, maybe see if anyone close to him is saying stuff. Sorry, I got off a topic on there, but The Snowball, Poor Charlie's Almanac, You Could Be a Stock Market Genius. This new book I'm reading, I could already tell is going to be one that I reread every single year, The Joys of Compounding. And that's a great book.
That's one I have not read yet. That's new this year, right?
Yeah, it just came out, and it is somewhat, it's an investing book, I would say, but it's also a lot more on like life and mental models and that side of the world, which obviously what I enjoy. But what else do I like to read? Yeah, Principles is a great book as well. Ray Dalio. Yeah, that's a good book. I would say those three.
Yeah, and then in terms of things that aren't books, you've tweeted out lots of times all sorts of different sorts of bits of information stuff that whether it's interviews, class notes, all sorts of things that you tweet out that are good, have lots of interesting things about different, super investors.
Joel Greenblatt's Columbia class notes, special situations class. I've probably read through those things probably like 6 times.
Yeah, so sometimes it's things like that aren't, officially books or whatever that you might look at a lot.
Definitely. Alrighty. Next question. Any suggestions for calculating ROE or ROCE? You put Greenblatt in parentheses, so return on capital employed, when the company has negative equity and or treasury stock on the balance sheet.
Right. So from an accounting perspective, you can't do that. So it would depend on the situation, but to be completely 100% honest, in most cases, it does not matter. So there could be unusual cases where it would matter, but the truth is that it's not. I mean, I think I've said this before, but for instance, if you were earning more than 30% after tax on tangible equity, let's say, it's really irrelevant in terms of your long-term investment, whether you're earning 31% or 101%.
Yeah. What
would matter at that point is just how much you were reinvesting in the business. And you're going to find that if you're reinvesting 100% at 100%, then the stock would trade at a crazy multiple, and everyone would, all growth investors would be buying and stuff because it would be obvious in the growth numbers. The reason why I say 30% is that almost no companies over very long periods of time compound their actual stock at 30% or more. You're going to see most can't do much better than 20% even over very long periods of time. Even something like Berkshire Hathaway had periods of several decades where it did 20% plus, but didn't hit 30%. Most of the companies you can think of that are amazing stocks over long periods of time still didn't compound at more than 30% a year. So it just isn't that important. What would matter is how much you're retaining when you get to those sorts of levels. So the easiest thing is just to try to figure out if it did have equity, would it be like 30% or something? Because people have asked that question about like the core business of BWX Technologies, which I like a lot, and things like that. And it's just not important. They can't get another business that's the nuclear reactor for the Navy. And I know the return on equity is high enough that that's a better investment than anything else they could make. So it's usually just how much they can retain at that point. In terms of the actual calculation, no, you can't do it. I always do a calculation of gross profitability divided by total assets too. So I do a bunch of different calculations that I don't really talk about. I also do different calculations by using property, plant, and equipment at cost instead of depreciated to check on certain things, stuff like that. There's all sorts of things that you can do. You can also, it's also helpful to do like a DuPont type analysis where you separate out the factors. So you would want to take out the leverage factor there, but you can still do calculations based on turns and margins. If you ever see any examples of singular diligence, which I did. There's some pretty good examples of us trying to figure that out for companies that have negative equity and things like that. Yeah.
Cool. What stock would you buy and hold for 3 years if you had to?
For 3 years?
3 years.
Well, I would have to not name anything in our managed accounts.
Yeah, because obviously you think about 5 years.
Obviously, well, no, I mean,
but if we're not going to talk about that. But I guess outside of the managed accounts.
Well, it would be So all I'm saying is it would be stuff in the managed accounts. So obviously, because I make the decisions on what to buy in there. So, what would I pick for 3 years? 3 years. That's a real. You have an answer for 3 years?
I'm so used to looking at stocks within the overlook space.
Overlook space instead of large stocks. So, so here we go. All right, 3 years. Okay. It's one of three stocks if it's 3 years.
Okay.
So we'll check back in 3 years and see how bad a decision this was. It would be Cardinal Health, McKesson, or AmerisourceBergen.
McKesson. That always comes up on screen.
So it would be one of those three. Actually, it wouldn't be one of those three. It would be all of those three. I would say buy all of those three and hold them for 3 years.
So McKesson, Cardinal Health, and what was the last one?
What's it? AmerisourceBergen? What's the name? It's a combination of some companies. They're all three distributors of medical. They're drug distributors. So I would pick those three because you said 3 years, basically. So the reason why you do that for 3 years, here's the thing. What's going to work over 3 years generally is some sort of contrarian pick in which you pick a fundamentally good business that has some sort of reason why today it's expected to not do well. So like I picked Frost and Progressive a few years ago when the Fed funds rate was like at 0 to 0.25%. Now the stocks have done well because the Fed raised rates. I picked some companies that consumed oil back when oil was $100 and some a barrel, that sort of thing. You pick it based on something that seems like it's a big concern now that might not be in the future. And so what's going to happen over the next 3 years is you're going to have a presidential election, right? Mm-hmm. And you're going to have a ton of rhetoric and stuff from each side, and at least one of those two sides will be talking a lot about making big changes to healthcare. So it would be something that you think is a good business that has a really low PE and stuff. It's a super predictable business. It's the kind of business Buffett would buy, but there's something temporary that after 3 years will be lifted one way or the other. So that's what you would do. I presume that those stocks will be under pressure all the time because of expectations of huge changes to healthcare, but you kind of just bet on the fact that there won't be big shifts. And that's not a political bet or whatever from my perspective. I'm just saying that almost always that's the case, that people project too much of what's happening right now into the future and assume that that will be the case. So yeah, it would be those three basically.
Cool. And then the last question, it says, what are your thoughts on inflation, and how do you factor that in when you analyze a stock? Like, how do you think about inflation when you analyze a stock or value a stock?
Sure. So, I mean, I guess I would just use 3% for inflation normally. How do I value a stock taking inflation into account? Some stocks benefit more from inflation than others, or I should say some stocks are harmed less by inflation than others. I basically take into account how much I think I have to pay for that inflation protection. And I think the answer right now is nothing. So at the moment, I think it's a great idea to buy anything that does well with inflation. I don't mean you should buy anything that's not a good business or something, but I've talked before recently about Timberland, for example. It's not that I love Timberland. It's just that I think... So Timberland is an asset that goes up a lot during inflation and does only sort of okay in low inflation environments, but it's not being valued especially high compared to other things, whereas sometimes something like gold or something is being valued, to take into account that there might be a lot of inflation. A lot of the stocks in our managed accounts have some sort of thing where they would sort of benefit more from inflation. There's some sort of cost plus type thing or some sort of real aspect to them. So my answer right now is I think too many people right now are kind of assuming that inflation will be low. That's not a prediction that inflation won't be low. It's the same sort of thing that I just said, basically, which is inflation's been low for like 10 years. I have no predictions about what inflation will be in the future, but generally the best thing to do is if you have a 100-year period which says one thing and a 10-year period which says the other, everyone will be betting with the 10-year period. You take the 100-year bet. So you bet on the, what you want to call it, reversion to the mean or whatever. So if the average Fed funds rate has been 3 or 4% and it's 0 to 1%, you bet it'll someday go to 3 to 4%. If people are saying inflation will go below 2%.
Which is what you did with Frost.
Yeah. And it's what I did with oil.
Yeah.
Same thing. I was like, let me find some airlines, some cruise companies, anyone who consumes oil. What are the best companies in that area?
I think a good way to how you thought about it was it's not like you were exactly making a macro call, right? It was just so much at an extreme point where you're like, okay, you like 5 to 10 years probably down the line, it's going to be not where it's at currently.
Absolutely. Yeah. Absolutely. So that's what you do. So,
which makes the process simpler, if you will.
Yeah. So I would definitely say that you right now, it's a good idea to buy things which are more inflation protected, but only because other people aren't doing it. As soon as other people are doing it, it's not worth it. So once inflation was really high in the 70s and 80s, there was often too much going into certain asset plays and things like that. And so then it didn't make sense to be in them. But if you get it for free, if you get that possibility for free, then you should take it. And that's true with other things with stocks where, like, well, Buffett's preferred and warrants deal. The preferred gives him a good enough return if to finance a merger in oil is what he's thinking about doing, or his pledge that he would do. Yeah. He gets the preferred, which gives him an adequate return, and then if things turn out well, the warrants are this kicker that he gets out of it. That's the way to think about it. Don't ever pay for a stock in a way that you need inflation to get the return you want. But if you can get a stock for the same price and get more inflation protection, get more of a benefit from inflation, then absolutely do it. And it's to some extent, some of the things we own will work out okay if there's no inflation, and will work out great compared to other stocks if there was a lot of inflation. That's not because I'm predicting inflation. I just think that the stocks trade at like the same PE and stuff, whether they have the power to raise prices or not.
Cool. I think that was a pretty good explanation. So I want to thank everybody so much for tuning in with us. We do these Q&As a lot now, so if you want to have a question answered on the show, feel free to either email us, gannoninvesting@gmail.com, me, info@focusedcompounding.com, or tweet at me. That is at focusedcompound on Twitter. In the last Q&A, we did talk about how we are doing 2 YouTube videos a week now, just exploring new types of content. There's obviously a bunch of different things we could do there, so feel free to follow us on YouTube at Focused Compounding on YouTube. If you like the podcast, you want to join our website, use the podcast promo code, which is podcast, and I'll take $10 off of the monthly price, and definitely as long as you do stay a member. I want to thank everybody so much for tuning in with us. Have a great week. We'll see you.
Hey, this is Geoff Gannon, and that was the Focused Compounding Podcast, the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focusedcompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focusedcompounding.com or text or call Andrew at 469-207-5844. That's 469-207-5844. Thanks for listening.